So, good evening. My name is Bill Kaler. I'm the Dean of the Sloan School of Business and Communication at Regis College. And here tonight, as part of our Operation Moneywise series of lectures with a couple of very important guests this evening, we have Mr. Lyman Jackson and Mr. Andrew Holmes, uh, personal financial planners from Financial Planning Solutions LLC, who are going to talk to us this evening about how to plan financially in terms of savings, budgeting, and investing with a particular eye on the needs of veterans. Uh, so, thank you, gentlemen, for your time this evening, and I will turn it over to you.
Sure. All right, so is everyone seeing my screen now with the title slide on it? Good to go? Awesome. Yeah, so thanks again to Bill for having us, and the entire team at Regis. Really appreciate you guys taking the time to put this together. And, we think it's gonna be a great event for those involved too. We also appreciate everyone out there in the audience. I know that it's probably the most beautiful day of the year today. So, we'll keep this short. And I know as far as time frame, we're looking at probably just 15 minutes of going through a couple different slides and some educational pieces that we want to share. And then the last 45 minutes, we wanted to open up to questions that you may have out there in the audience for you. Um, so I guess without further ado, I'll just dig right into this. So we'll start with just a brief little background on us here. So Lyman and myself, we come from Financial Planning Solutions. It's a small little RIA in Newton, Massachusetts, so not too far from you guys. And, we're financial planners. We serve roughly around 200 families, locally and kind of throughout the U.S. as well. And, for some background on Lyman, so he's currently a managing partner of the firm. He established the firm in 2013. Along with his partner, Richard Fingerman. And then, he's essentially been in this business for 30 plus years. And his primary area of focus right now is working with, young professional families, as well as those trying to save for college at the same time. For some background on myself, so I'm Andrew Holmes. I'm a, Bentley University graduate a couple years back. Since I graduated, I was taking some classes at Boston University and recently received a certificate in financial planning from them, and then passed my CFP exam this past March. Still waiting on an experience requirement to be able to use those CFP marks, but they're on the way. And then as far as my line of work, I work primarily with younger professionals, those in their 20s and 30s, just helping them to get off to a start financially. And as well as some families with juniors and seniors in high school with some fun late stage college planning and college savings around that area. So that's a little background on us. The next thing we wanted to get into is just a quick overview of the agenda. So, Bill mentioned some of the primary topics we're going to dig into is budgeting, savings, and investment. But before we wanted to get into that, the first thing we wanted to look at was just goal setting, as in our opinion, in our line of work, we see this is probably the most instrumental piece to start with. The other pieces fit in and they help to build out your finances, but without setting goals, they don't really do too much on their own. So we'll start with a little piece on goal setting, and then, digging into the emergency fund as a piece of your savings, then digging into a little bit on budgeting, followed by investing. And then, as I mentioned, we'll save the last 45 minutes of this presentation for Q&A. So feel free to ask your questions. In addition, for those of you out there, if you have questions as we go through the slides, feel free to, use the chat function to ask, and we can address them as we go along. But, some of those larger ones, if you'd like to speak up, it's probably just easier to save at the end, and then we can address it in the Q&A session. Okay. So where we'll begin is, I guess we call it the most important money question. And that's just, what do you want your money to do for you? So we think of goal setting as one of the most important pieces of this, because it really helps to define, what you want to achieve. And, while our clients kind of come from like different backgrounds and retirement planning seems to be a focus for a lot of financial planning. These can be, short-term or intermediate-term goals as well. So, instead of retirement, maybe it's something like I want to buy a house in 3 years, or, I want to save for my child's college education down the road, or even something as small as like, I want to travel on a trip to Costa Rica, say next year. Just establishing these things now, you can use financial planning and allow your money to grow over time to help you achieve these goals, which is something that we see every day in the work that we do. So again, we really just recommend taking some time to yourself and writing down a couple different goals that come to mind, and then based on that, we can make a plan for how to get there. And as the components of this presentation will show, budgeting, saving, and investing all play a really large role in that, which is pretty special. Okay. So the first thing that we wanted to dig into was the emergency fund. And, we had to toss a little recognition here to the office just because I had to lighten up this presentation a bit. And especially with something like the emergency fund, it's something that you probably don't think of as like, the most fun part of investing. But it really serves a super critical role. And, we refer to it as, I guess, like the oh shoot fund, because it's there to protect you when things go wrong. So you can think of this as what you have there, if needed, if something like, an unexpected medical emergency happens, or let's say your car breaks down, things that you can't prepare for. If you don't have ample cash on the side, you may have to reserve to, consequences that you would not enjoy otherwise. Things like if you had to, put it on a credit card, or, take out a loan at like an unfavorable interest rate. Things like that can really be devastating to your finances otherwise. And I guess on a personal note, I can kind of share a story here as far as like the importance of an emergency fund. I kind of think back to, when I was in college, when the freshman and sophomore year, I was just starting to get really interested in, investing in stocks, things like that. And one of them that came to mind was, being a huge baseball fan, Under Armour was a name that I was like, wow, that sounds like a good investment. I didn't, again, I was just a beginner investor, didn't really know too much about it, but I made some money over the summer, and I was thinking, why not make a little bit on it, invest it in the stock market. But I wasn't thinking ahead. I didn't have an emergency fund planned. And the following semester, my plans were to study abroad when I was in Spain. And I only had about, $3,000 in cash that was supposed to last me the semester. Well, figured 2 months into that adventure, I found myself short on cash. Meanwhile, the Under Armour stock that I was invested in, was plummeting over that 6-month period. And that forced me into a scenario where I had to, sell low on the stock just to make sure I had enough Spanish rice to last me in Barcelona an extra couple of weeks. But as you can see, just the importance of having the emergency fund, it's not there to make you a high yield or high interest rate. Think about it as just the security blanket that's there should you need it. Okay. I guess next we'll dig into budgeting here. And budgeting is also kind of it's a funny term to us. I mean, it kind of has that negative connotation to it. And for many people, I think they're not as interested in budgeting just because, it involves looking back in some of those previous expenses that, you may look back on and say like, wow, I shouldn't have spent this amount of money on, let's say takeout or Uber Eats or something like that. And it's kind of like a punishment to look back on those things. But I think what we look at more so in this sense is to use it as like a forward-looking instrument. And it's really powerful, especially if you can use it to organize it with some of your goals. So, as we mentioned before, if you can start setting goals, short, intermediate, and long term, and then help to use your budgeting to align it with that, you can really see the power and importance of it. So like an example that we'll move into here. So for example, let's just say, after sitting down and writing down some of those goals to yourself, if you thought, I really want to make sure I can travel more would be really exciting. You know, I also want to spend some more time with my friends and family, and then just being responsible and investing long term. If that was of interest to you, you would set those goals, and then in looking at your budget or your expenses, you can adjust that to get more aligned with your goals. So in this example, you'll see on the bottom left hand of the screen, we have those previous monthly expenses, which I don't know how accurate those are, you know, with the COVID scene. As far as $300 dining out, it seems a little high. And maybe the takeout number is a little bit higher than that as well. We'll see. But in doing so, you can adjust those new monthly expenses. So if you really say, I don't really care too much about my takeout, my dining out, and, you know, I'd rather spend more time with my family, and let's say, like, you know, bring home the pizza dough and do like a pizza night or something like that, that's inexpensive and you still allows you to spend time with your family. But also, let's say on the side, you can save more for, let's say a long-term goal is a trip in 2 years, to go to Europe with your family. Putting away that money monthly and watching it grow, you'll quickly notice that, you know, it really, just aligning your spending with your values will make you happy with the way you spend your money. And, you know, in addition, if you can watch it grow long term as well, it's really important.
Yeah, I think
Um,
just to jump in here, Andrew, I think, one thing that you and I talked about when we were trying to put this presentation together was that, the budgeting process, conjures up visions of like dieting and, attempts at losing weight or joining a gym at the beginning of the year. And, that's part of the reason why we try not to think about this topic as budgeting per se, but more about just kind of realigning your goals for your money towards things that are the most important for you. And where that begins is looking at where you're currently spending your money. So it doesn't have to be all bad or kind of a negative thought. It's really more of a productive prioritization that's how we like to think about it.
Definitely. And it can be like an incremental process too. You know, it doesn't have to be kind of everything at once, but those little small changes that you make in your daily routine, you'll notice that over time those will compound and, you know, create some major results, which is really intriguing.
Mm-hmm.
So the next piece that we wanted to look into would just be investing. And I'm sure investing has been not a lot in the news lately, as far as looking through some of those, you know, Bitcoin and some of those, well, cryptocurrencies, as well as you know, some of those entertainment stocks that people got involved with in February. But I guess our thinking on here before investing, you know, we really wanted to reemphasize, to start with, just having that adequate emergency fund. Because as I mentioned before in that story, if you don't have that, you'll quickly realize that if the tides turn and the market shifts, or even just the financials of the company that you're investing in change quickly, if something happens and you need that money, you'll be forced into that scenario where either you have to take out an unfavorable loan, or, you know, toss it on a credit card, which these days, I mean, if you have a balance, you could be paying anywhere from 15 to 25% on them. And that kind of leads into our next section here on paying off high interest debt. You know, if you are currently carrying a balance, and if it is in that 15 to 25% range, think about, instead of investing, if you were to pay off that debt, you know, essentially that's, you know, getting a 15 to 25% return on your investment. So that's just kind of an alternative way to look at it, that, you know, starting investing is important, but if you don't have that financial background, or the financial, I guess, just the starting point there, that, you know, it's kind of an uneven ground, and it can go against your favor pretty quick. And next, we want to just quickly touch on investment time horizon. You know, I think with a lot of us as investors, you know, we think about investing, we see the short-term movements in the market, you know, as we're watching the market move up and down on a daily basis. But it's really important to think back to, the goals that we mentioned. And if you have some of those longer term goals, to make sure that, you're thinking about your investments in the same kind of light. Whereas some of those shorter term goals, so if it's something like, a vacation fund or home improvements that we have on the slide, know that they should be in more stable investments, because the market can shift pretty quick. And if you're caught in an area where you need to, make that down payment on a house in 12 months and it's currently invested in the market and the market shifts, obviously you'll be in an unfavorable place and you may not be able to move into your house in the expected time frame. So that's really critical. It's just to make sure that your goals are aligned with your investments here.
And in times like these where the stock market has performed really well, it's easy to feel confident as an investor and think that, well, Tesla's a really interesting company, or, some other stock, just pick something that kind of hits the headlines on any given day. It's not always the best idea to kind of follow those headline companies without having thought about, what your particular needs are and whether you can afford to put money away for a long period of time in an investment. So remember that investing can be a very emotional experience. We all can get caught up in some way in thinking that, oh, if I could just pick the right companies or the right investments, I could, make a lot of money and not have to work anymore. Well, successful investing usually takes place over a long period of time, to be quite honest. It's not something that's glamorous or exciting to promote, but it's been our experience that that's where people really accumulate, a solid financial footing and wealth over time. So just some words to the wise on trying not to get caught up in the moment.
Absolutely. And I think that's kind of a good segue actually into the next slide that we had on here. As far as diversification, I know Lyman mentioned Tesla, but I'm sure some of you, if you're younger investors, you may have kind of got caught up in that craziness. And if you're just starting out investing and you're investing in one stock, I mean, essentially, as we mentioned here, you're kind of putting all of your eggs in one basket, and at the same time, you're increasing the risk associated with your investment. So, as far as the way that we look at diversification, it's kind of like on the left, you see the image of the bridge that looks pretty shaky. I don't think I would want to be sitting there. But if you're invested in one stock and all of your portfolio is in that one company, if something happens to that company's financials, or even the market as a whole, you can lose everything. Whereas the bridge on the right here, we see kind of has different supports. So, if your portfolio is made up of a number of different companies, if one of them were to, have disappointing news financially or even go bankrupt, as long as you have, a solid number of other companies to base it off of, overall your investment portfolio will hold up. And as far as diversification, it's not even just among different like regional stocks, things like that. It's also you can diversify across different asset classes, so having both stocks and bonds, investing in other markets. So like, we think of a diversified portfolio as including both US and other global companies as well, and companies of different sizes, small and large, and industries too. So those all kind of play into the diversification there. We have a couple more. So let's see. We really wanted to make a point of getting started as early as possible. For those of you out in the audience that are younger, this chart just kind of represents the impact of starting getting started essentially with your investing is, honestly could be even more important than choosing the right investment. In fact, just to, you can see here that, someone that starts at age 25, this is a $5,000 annual investment, and an 8% rate of return over time. And just watching how that money can compound over time, to age 65. So with this chart listed here, you'll see that if you're investing from age 25 to 65, there's a 40-year time frame on there. And it gets progressively smaller. If you start investing at age 30, 35 years, start at age 35, there's a 30-year time frame. But you'll notice that the real increases here are just due to the additional compounding that results over time. So, you can kind of think about that in the way that, like, let's say you have $100 in the bank, and if you get like a 1% rate of return on that, at the end of 1 year, you'll have $101. And then the compounding works where, that 1%, it won't be for the second year, you won't be getting 1% on that original $100. You'll be getting 1% return on that original $100 plus $1, so $101. And over time, you can just see incrementally that, maybe it won't pick up as much in the initial years, but longer term, having a solid start early will really pay some dividends in the latter years. And this is just a little graphic that we thought would be a good little sum up to the investment piece here. I know Lyman mentioned more of the day-to-day is just kind of what we're seeing, especially with some of those volatile stocks. But we really, if it's long-term money and money that you're putting away for, some of those longer-term goals like retirement, or, if even like buying a house is 10 years down the road plus, things like that, it's really important to have that long-term view here, and to not get kind of sucked into the day-to-day, as, over time the market, it will have pullbacks, and, if you're an investor, you may see some losses, but it's really important to focus on what your goals are. And if they are long-term, to just stay focused on those goals.
Yeah, and just thinking of in recent times, about a year ago, when COVID was just hitting, the U.S. stock market, actually the world markets took a huge hit and declined very sharply. And so, if you were kind of thinking about your investments in 5-day increments, you could be making trades or making a decision right away based on what was happening there. Well, hindsight is always 2020 when you're looking at these things. But here we are more than a year later, and the returns during that 12, in the 12 months since then have been absolutely amazing. The stock market has risen dramatically, and we, who knew? During the dark early days of the pandemic, it's always hard to know what's around the corner. But we always go back to the many different points in history where things looked really grim or really bad, the financial market meltdown. And, you can think of times like that when, maybe you personally were worried about your investments or your retirement account. And it's really wise to think, well, now look where we are, things have recovered. It doesn't always happen overnight. Sometimes it takes a really, really long time. But if you have the ability to invest for a long period of time, there's the opportunity for a recovery. And in this case, of course, we're very fortunate to see a strong recovery from a year ago.
Absolutely. Yeah, it's amazing to see just over the course of a year, all this occurring. So I think we went a little bit over on our 15 minutes, but not too bad. We'll see. As far as our key takeaways here, we kind of want to just summarize the different pieces that we touched on. So I think initially it's really important to spend some time, write down some of those goals that are important to you first, have that as a background, and then you can really look at it to, start with your spending and your expenses, get that kind of aligned with, the goals that you're looking to achieve. And again, you'll feel better when you're spending your money on things that, you really care about and are, good values for you as well. And then, when you're ready to save and invest after, establishing that emergency fund and paying down if you have credit card debt, things like that, you can really use your saving and your investing to help you achieve your goals long term. Again, we focused on not being caught up in the day to day with investing if it's a long term goal, but staying focused. And over time, you'll see growth in your investments, and then growth towards achieving your goals long term as well. And then the last thing we had on here was just speak with a professional if you're needed. A lot of these things can be very complicated to people, especially with the investment piece. And what we found is that, those that do work with a professional, you can really help you to kind of stay on track with some of those, with your goals, I guess, number one, but really show you different ways that you're incrementally achieving the steps toward your success. And, in addition, help you avoid mistakes along the way. And then, probably the best part of what our job is as advisors is, helping our clients reach their goals long term, and when they are fulfilled, obviously that's probably the best part of our job. So, that's the key takeaways we had from here.
Just one quick addition there, Andrew. For those of you who are veterans, I mean, there are a number of special preferences afforded to veterans, whether it be through student loan arrangements or credit cards or investments. There are companies that specialize in working with veterans, and I would encourage you to seek out some of those organizations because they tend to offer some attractive values there. But of course, as it relates to a professional, we always suggest that you get some recommendations from friends or family. It's a great place to start if you're trying to figure out who to talk to, and then kind of check them out online and see if everything makes sense and makes sense for you, especially.
Definitely. Yeah.
Excellent. Well, thank you so much to both of you for those insights. You've answered a lot of questions, I'm sure, for the audience as well as for me. I've got a number of questions myself because I'm a curious fellow, but wanted to see whether there were any other questions before I jumped in.
Yeah, let me just, we have to show this quick little disclosure here.
Oh, absolutely.
For compliance reasons.
Fire away, Mr. Holmes.
You're good. But yeah, just to note that this was educational in nature. And then, we can hop right into those questions.
Yeah, that mention of Tesla was neither an endorsement or anything else, just mentioning a company.
I'm assuming that a lot of our younger investors have probably been burned on Tesla over the past several months. I've been following it pretty closely myself. But one question to start us off, if I might, gentlemen, is what do you see as sort of the biggest spending mistake that young folks are making today? Because I think you were right to start with the sort of spending and budgeting side of things before you moved on to the saving and investing.
Well, I mean, do you want to start and I'll hop in
Andrew,
after?
that you're the man in that department, the young man, so you get to give first whack at that question.
I guess so. I mean, I guess we see a lot of it. You could probably loop me into the category too. No, I think it's just being cognizant of your spending more so. Like I said, no one really wants to talk about like budgeting. It's not one of those things that you'd ever really. I think the biggest mistake would probably be not focusing on budgeting, but not doing it, I guess, because it's like not a fun activity. I think the mistake would be like, if you can learn how to budget and make it into a fun activity, like maybe, I don't know, if you're like with your spouse or something like that, and you make it turn into like have a glass of wine, look through your budget, some way to make it, not as much of the going to the dentist office kind of activity. I think that's super beneficial.
Yeah, we have a couple of clients who have a once a month financial meeting with their spouse, and they have a glass of wine or pull out some beer or their favorite drink, if they're not drinking, So it doesn't really matter how you want to go about it, but having a conversation about it is a really, just these little conversations sometimes can make big changes in the way you think about your approach to where your money goes. And I think, where we see things that have gone wrong is it's often those quicker decisions where someone made a decision that involved a lot of money and they didn't really kind of check around much first. So those can be kind of risky propositions, to think about carefully before you make a big move. Quitting your job and deciding to travel the world for 12 months sounds like a fantastic idea, but if you're not really sure what things are going to be like for a job when you get back, or you have barely enough money to do it, maybe you want to make that 6 month or a 3 month adventure instead of a 12-month one. That, but that's a fairly big decision. But who doesn't like to travel? An awful lot of people do, and of course, after this year that we've just had, everyone's really excited about getting out and seeing places, and especially places that we weren't able to go to last year.
A lot of pent-up travel demand from what I've heard.
Mm-hmm.
Wanted to throw one more question out to you, gentlemen, if I would, because this is one question I get from students who don't have much investing experience. And the question I hear often is, where do I start? Do I start with, an exchange traded fund? Do I start with a mutual fund? Do I start with a single equity? Obviously, once you get to a certain level, talking to professionals such as yourselves makes a whole lot more sense. But if someone's just putting a toe in the water, what advice would you give in that regard?
So I guess I would start with, like, it kind of depends on kind of where you're starting investing to. If you're, let's say it's in like a corporate 401k plan or something along those lines, you'll have the limited options there. And something like along the lines of, if it's like a targeted investment date portfolio that's tailored towards a retirement date, especially if you're a beginner investor, that's an area where, again, it won't be like that customized solution, but it's meant to provide simplicity there, and a good solution to help you start saving long term.
Yeah, I would just add to that Andrew's right. I mean, it does depend on the type of account, but some folks start with say $100, and that's maybe in addition to money they're putting away in their 401k or their 403b or other retirement account, and they're doing it as part of a learning experience for the investing part. So if it's a small amount of money, the stakes are smaller too, if you're investing directly like in individual companies, but definitely take it slow. I mean, if you don't really know where to start, a target date fund is basically a managed account. A balanced fund, which invests in both stocks and bonds, is also a managed account. The decision about which stocks and bonds to invest in is already taken care of for you. And that can be in the form of a mutual fund, but there are also balanced accounts that are exchange traded funds, which is basically index funds. So, those are good places to start, see how it goes, see how it behaves, see how you interact with it over time. Like when the market drops, you can kind of take a look and see how much that investment goes down, or conversely, when the market rises, how much it goes up. And as long as you're comfortable with what's happening there, then you can kind of proceed and add to it.
Makes great sense. We do have a question from our audience, gentlemen, asking what's a good percentage to put into savings for future home or educational loans? Right? What kind of a, if there's a rough benchmark, what would you folks suggest as, is it 10%? Is it 20%? Is it 5%? What makes sense as a general rule of thumb?
Well, I'm going to jump on this one. So there's a couple of rules of thumb as it pertains to saving long term. When it comes to retirement saving, what we know from a number of different studies that have been done is that over the course of a career of working, one generally needs to save about 15% of what you earn, which probably sounds like a lot of money. But the reality is that during your working career, you may not be fully employed 100% of that time. There might be a period when you are between jobs, when you're not contributing anything to your retirement plan at work. There might be a period when you're unable to contribute for retirement because you're saving for a house down payment, for example. So that's the rough guideline on retirement. If you've already accumulated, a significant retirement account, it may not be 15%, but that's just a rule of thumb. As far as a house purchase, if you're living and working in the greater Boston area, it's probably no secret that housing costs are very high to buy a new house of any kind. I feel my heart goes out to anybody who is looking for a house right now, because the hurdle has gotten kind of much higher. But we're working with a number of clients right now who are trying to do that very thing. And basically, a strategy that many of those couples or single people are pursuing is they're going to make that their one important singular goal for a period of time, and they're going to put all of their excess cash flow into that so that they can build up a big enough down payment in order to have hopefully 10 or 20% down on the house. Basically, a large enough down payment that they're not going to have to pay private mortgage insurance.
Beautiful advice, gentlemen. A follow-up question to that. When you're looking at clients who have a lot of debt, student loan debt, credit card debt, auto loans, et cetera, how do you advise them to get started on the path to this financial recovery?
So I'll just start by saying that, oftentimes when we see this, it could just be overwhelming to start. If you have, let's say it's $100,000 in student loans or credit card debt or something like that, it can be really difficult to see some of those larger loans. So, while you can take the strategies of, paying down the highest interest loans first, sometimes it is overwhelming and you can feel like you're not making as much progress at it. And a kind of an outside the box strategy that sometimes people, really find value in is kind of to make noticeable progress is to chip away at what you can, chip away at the loans that you can pay off, and incrementally see your progress grow over time. And while that kind of conflicts financially with emotionally what you're seeing, I think sometimes the emotional side of seeing that you're making progress on paying down the debt can have sometimes even a greater impact than the other way around.
Can't hear you.
Sorry, I was muted. That makes great sense. As a follow-up, when you're identifying which debts to pay down first, what's your general advice in that regard?
All right, so I guess it's my turn. So the general strategy would should be to pay down your highest interest rate loan first, if possible. What Andrew, of course, was referring to is that sometimes you're not paying off the rock bottom, or I'm sorry, the absolute highest rate first, because it's important to get some momentum, in our opinion, to the fact that you can beat this thing long term. With student loans, it does depend a little bit on the type of loan that it is. If they're federal loans and you're eligible for income-based repayment, those are also opportunities to maybe manage the payment flow better, especially if you're trying to save for a house down payment. If obviously you have to qualify, your income has to be low enough from the work that you currently do in order to have an adjustment to the payment that you're making. You need a place to live. So, buying a house and saving for a down payment, obviously those two things, having the student loans and also trying to buy the house are two strongly conflicting financial obligations. It's hard to try to navigate that. And some of it, of course, depends on how big is the student loan balance and how much money are you trying to put down. But again, there's more than one way to go about this. While your dream home might be a 4-bedroom colonial in a nice community like Lexington or Weston or Newton, or one of the more expensive W towns west of Boston, you don't necessarily, for your first home, have to be in one of those houses or towns, perhaps. I mean, maybe you'd like to be there. There's the saying of a starter home, right? And that allows you to build some equity. In other words, some value above and beyond what you owe on the property. And so you could say 5, 10 years down the line, you've built up some equity and at the same time paid down some of the balance of the mortgage. When you're ready to make the next move, you're in a more powerful position in terms of buying your next home. And of course, at the same time, you will have continued to make student loan payments. Those balances will be lower too.
Beautiful. The way a financial advisor years ago had expressed it to me, he said, hey, you don't expect your first job to be your last job, but it helps you get there. The same way your first home helps you get to your dream home. Is that kind of what I'm hearing from you, sir?
Yeah, I think that's just, again, it's when you can't seem to figure out, how do I get to my ideal home given housing prices today, the towns I'd like to live in, and I just can't see a way to do that. Think about more options, different ways to do it. Maybe you buy into a condo first, and then later move into a larger house. Granted, it can be tough if you've got say 3 children and you need some space for the kids, and you want a backyard for that. But it's a balancing act, and it's better to try to do it within your means than stretch too far and then experience a job loss and then be unable to make your mortgage payments, which could lead to a financial crisis. So
yeah. And then I think on top of that too, another thing we can discuss too is just that there's always kind of that mindset that like renting is throwing your money away. But in some circumstances, if you do plan on, you're not sure if you're ready to find the right house yet, you may be moving pretty soon. It may be worthwhile. Other things too, like remember that you're not, paying some of those like home improvement costs, things like that. So in some scenarios, it can be optimal to rent as well for a little bit longer.
Right. Everybody's had the bad landlord or the guy who never fixes anything and all of that. But don't forget, being a homeowner is not headache free. Homeowners have to make improvements. They have to replace their roofs when they would rather be spending that money on a vacation. They have to do yard maintenance. They have to, make sure the house remains in good, decent shape. You have to replace appliances. You're not really dealing with any of those things as an apartment dweller. It doesn't mean you have to be in an apartment for the rest of your life, but it's not always like a slam dunk to be a homeowner. Um, Take your time, make sure you find the right situation that you can afford, and if you have to take incremental steps to get there, you know, try to be open to that. You can.
Wonderful advice. In my experience, for every bad landlord, there are probably 10 bad contractors. So that goes along with the advice to be a little wary
Mhm.
of home ownership unless you're planning on a lengthier stay, right? Um, Want to see whether there are other questions in the audience. I don't want to dominate too much. Um, and you can pop them into the chat or speak them out.
There are some in the chat, but I'm not sure if we fully answered
Mm,
all of those questions.
gotcha. Um, one more question. Thank you. On a budgeting front, is how should your budget change over time as your income and life circumstances change? Should you try to keep to a similar budget, or should your budget expand as your income does?
Well, that's a great question, and I have a different I have a non-answer to that question, which is um, usually people increase their spending when they receive an unexpected windfall of some sort. It might be a raise that was more than what they thought. It might be a bonus that was larger than they expected. It might be a bigger tax refund than they thought they were going to get. Any of those things qualify for what we would call a windfall. When those things happen, one of the best things that you can do is to think about your long-term goals first and take a significant portion of that and put it towards those long-term goals, because those long-term goals are really hard to save for, right? Because you need to keep putting increasing amounts of money away. And basically, when you're saving for retirement, you're saying, well, I'll forego some of my current income so that when I'm ready to retire or I have to retire, I'm not going to be in a really tight spot with no options and faced with the few options that I have are uncomfortable for me. So it's a great opportunity to, probably first and foremost, make sure your emergency fund is fully funded. If you don't have one, start one. Put a chunk of money aside in cash so that next time you have an emergency, you don't have to put it on a credit card at a high rate of interest. It's costing you money, and let's try to save you some money the next time an emergency comes around. Anything that's a plannable, like if you know your car is going to have to be replaced in the next year or two, um, set aside some money for that. Put that aside. Then once you get you've whittled down whatever that windfall was, and you have, you know, maybe well less than 50%, then you can think about things that you might be kind of fun that you like to spend it on, or indulgences perhaps. 50% is not a very high bar. I'd say, once you've allocated maybe 75%. And of course, if you have student loans, which are one of those things that everyone wants to be rid of as soon as they finish college, you can take some of that money and eliminate it, one or a couple of those loans if possible, so that you now have cash flow from not making that payment, you can then put that towards the other student loans perhaps, or towards a savings plan. But don't let that money, those payments that disappear, don't let those escape without being reallocated to something else.
Excellent advice. It sounds like, I have to say, although some of us may follow it too often in the breach, I think. Gentlemen, I really want to thank you for, providing us a really useful look at things big and small, short-term and long-term, that our veteran community and all of us need to do to secure our financial futures. We really appreciate it. For those of you who are looking for additional information about how to manage your resources, I encourage you to reach out to the firm here, Financial Planning Solutions LLC. And obviously you've heard from the wonderful representatives there. For those of you who are interested in furthering your education, please feel free to reach out to me. I put my email in the chat, or to Dean Laura Bertonazzi, our Dean of Undergraduate Admissions at Regis College, and we're happy to help you on your path. Really appreciate the time you've taken and the thoroughness of this presentation, and I hope all our veterans heed your advice, gentlemen.
Thank you so
Thank
much
you
for
having
having
so
us.
much for a wonderful
Yeah.
event, and we'll be distributing this across our networks as well afterwards. So thank you all.
Great. Thank you.
Yep.
Have a good evening, folks.
You too. Good
You
night.
as well.